In this video, we're going to look at the difference between contango and backwardation in the futures market. Stay tuned. Hey traders, a very warm welcome to you. Okay, so in the futures market, we have a scenario where, generally speaking, the futures price is going to be more expensive in the future, i.e. when we take delivery of that underlying asset in the future. That is a normal condition, and the further along we go, the more expensive it is. Now, why is that? That is purely because we have a cost to carry. And if we consider an example like crude oil, normal situation for crude oil is this. Contango market, where the spot price is here, and let's say the spot price is $40, a futures contract to have that crude oil now for 1,000 barrels of crude oil, or whatever contract we're looking at. 12 months in the future, that's gone up to $60. Why is that? Because there's a cost to storing that crude oil, there's a cost to insuring that crude oil, and there's also the interest that you lose by tying up that money. There's the opportunity cost, which has to be accounted for in the futures price. And that's kind of basic futures pricing. And go and check out another video I've done where I've talked about how futures prices are made up. So that makes perfect sense. That's perfectly logical. If someone's got to pay for storage, insurance, and all this kind of stuff for the crude oil, and you want it and you say, hey, I want it in the future, I don't want it now, there's a cost that comes to that, and that's understandable. If you're going to take the cost of it now, you take the crude oil now, you've got it then. You've got to insure it, you've got to store it if you want it used in the future. So it makes sense. There's like an additional service being provided, as well as the underlying asset that's adding that extra premium to the crude oil. So that's contango situation, normal situation. Probably not the best phrase to use, but that's pretty much as you'd expect. Now, we have sometimes extreme contango, where we have really cheap front month and quite expensive far month, and this kind of graph goes, by the way, the x-axis here is our time. If you didn't get it now, 1 month, 6 months, 12 months, and this is our price, and purely hypothetical just for this example. So if we had a really extreme contango, that purple line would be very steep, and that could be for many reasons. That could be because there's a massive oversupply of oil coming at the moment and they're just trying to get rid of it. There's not much demand for it. It's all flowing, it needs to be sold, and they're expecting maybe that will shift out and right itself in the future. Now, this is when you could, there was an arbitrage opportunity, any extreme contango, there's sometimes an arbitrage opportunity, not necessarily for us as retail traders, but generally for the bigger players. If they can store that crude oil, if their cost to carry, so the storage cost, the insurance cost, if they're storing it in a kind of oil tanker vessel that got docked offshore, insurance for that, all the kind of stuff that needs that, and then the interest also. If that is less, their costs are less than the difference between the futures price there and the spot price here, they'll make some money. What they'll do is they'll sell the futures contract for, let's say, 6 months out, 12 months out, whatever it may be. They will buy the crude oil they've got now at spot. They'll get as much as they can. They'll fill it in their storage container, and they're assuming that maybe it costs them, I don't know, $10 a barrel to hold that for 12 months. Let's assume that's the same curve. So they buy it at 40, $10 a barrel. Their cost is $50. They're selling it at 60. They've made $10 a barrel over that period in time. So when we get extreme situations like that, then it creates arbitrage opportunities. Unusual, but it does happen. Backwardation, on the other hand, is when we have pure supply-demand imbalance. Why the markets, I always talk about the markets running on pure supply-demand. That is literally the name of the game. And when we look at backwardation, it wouldn't make any sense. If I say to you, hey, I'll give you crude oil now, $90, or if I say to you, hey, would you want crude oil to pay more for it now, $90? Or you know what, if you just wait a month, you can pay $80. You're like, well, I'll wait a month, I'll pay $80. I don't need it. I'll wait a month for it, I'm fine. If, however, you're desperate for that crude oil, let's say you're running a refinery business and you're cracking it into fuel and whatever other outputs you get from cracking oil, you're going to say, hey, you know what, I need it now. I don't have what I need it to keep my business running. I will pay that premium because I want it now. And so we have the shift in this curve to backwardation, where the front month or the spot price is high and the futures price is low. I know you can see why that is. It doesn't make any sense from a logical perspective, because there's an additional cost to carry incurred in this 12 months, and yet there's still a discount on the price. So not only is the cost to carry involved in that, but the discount as well. So you think, well, that doesn't make any sense. This is where we come down to things like, if you're talking about crude oil, perhaps there is literally a real problem with supply. You know, some pipeline's been damaged, or there's some geopolitical thing, or some anything that you know, the kind of the way this works with energy flowing, you know, through the countries. If there is a problem with supply and people need that crude oil to fuel their factories, to fuel their homes, to fuel their businesses, they're going to pay what they need to pay to keep their business rolling. Even if potentially they're making a loss on that quarter, it's better than them not having any crude oil at all. And so when you've got that limited supply coming in and you've got a large demand, you get this backwardation situation. And the expectation is that perhaps that short-term supply problem may well right itself, and why we kind of go back and there's a discount on the futures price 12 months or 12 months, 6 months in the future. So backwardation, Contango, pretty much just basically showing you how the front month or the spot price or the cash price is relative to far months, whether that be 6 months, 12 months out. If we're in a normal situation, it's going to be most of the time we're in Contango. If we're on an unusual supply demand situation, we're going to be in backwardation. All right, guys, thumbs up if you like this kind of stuff. See you in the next one. Take care. Bye-bye.